Well, good afternoon, everyone, and thank you all for joining us. This is Jim Jacobson. I am a Senior Vice President here and Wealth Advisor with Girard, and I'm joined by my colleagues David Geibel, who's working from home. He's President of Girard Wealth Management, and also Girard's Chief Investment Officer, Tim Chubb, who I also believe is at home. I'm the sole person in the office today. We're operating, as I'm sure many of you are, from a partial work-home, work-in-the-office type routine. So thank you for joining us today. We do appreciate your time. Today we're going to discuss the front half of 2020 and also take a peek at what might be on tap for the back half of 2020. But before that, I would like to have our President, David Geibel, open with some comments. Dave, welcome aboard.
Jim, how are you? Can you hear me fine?
Yep, I can hear it great.
Great. Well, you might hear my son yelling at Fortnite down the basement in a minute, too. I just had to go down and tell him to pipe down. So the pleasures of working from home is being surrounded by your family and all of those activities. So we'll see if he remembers in the next 5 minutes not to yell at his friends. So, well, it's great to be with you this afternoon and really appreciate the time that everyone's taking 45 or so minutes or less, hopefully, to take out of their day to spend with us today. Tim and Jim have prepared extensively for today's call. They're a wealth of knowledge, and once you get past me, the real show begins with the real smart people, as I'd like to say. I hope everyone's enjoying their summer. It's pretty hot here in our neck of the woods in southeastern Pennsylvania. It's probably hot where you are as well, and truly one of the weirdest summers we've all had. A lot of our activities and summer fun has been curtailed, but I hope everyone's able to enjoy some time away. I'd like to take a few moments today to talk to you about Girard, our vision for the future, and what that means to you. I am the new kid on the block. I took over as president of Girard and our 4 divisions on April 1st and replaced Kevin Norris, who truly has one of the best retirement track records in America, right? He retired on April 1st, right in the heat of a pandemic, a market swoon. So he's really smart. I'm not. I stepped into it. He stepped out of it. But I had the pleasure of working with Kevin for 20 years. I've known him for 25 years. I actually shared an office with him when I was a co-op at Drexel University. And I'm thrilled for Kevin to go spend some time with his 3 grandchildren, his wife, truly one of the hardest working people you would ever want to meet, a leader, a mentor, a friend. April 1st was an emotional day for me to say goodbye to him, and certainly it was under uncomfortable circumstances where I couldn't even shake his hand, but we will hopefully someday have the chance to do that. And my first act as president of Girard was to usher 75 people into a remote working environment, and fortunately we had the infrastructure to do that, which I'll talk about in a second. It's really about you today. I've worked at Girard for just over 15 years as an advisor, and most recently was running our registered investment advisory practice. And the coolest part of my job then and now, and the team, Jim and Tim, who we're going to talk to you in a few moments, is we've had the pleasure of being in business for quite a while. So we've watched our clients have success, hit their goals. We've ushered people into retirement. We've helped people go through very difficult circumstances and have gotten notes from our clients that say we couldn't have gone through this challenging time without you. We've helped our clients put their kids through college and move to a resort community in a warm environment where they can live out their retirement wishes. Our trust group has helped some of the most vulnerable clients in the population, people who can't care for themselves or special needs clients. Our pension group helps municipal workers, police officers, people who right now are on the front lines, build a better retirement future. A retirement plan group puts together retirement plans for businesses, a lot of small businesses that are economical and efficient, and educates their participants about putting $1 away now to save for their future. So our lines of business at Girard come to work every day, putting our clients' interests first. And even though it may seem incremental at times, we are chipping away at the iceberg to help people build a better future. And I can speak on behalf of our 75 employees. This is what helps us get up every morning and come to work. And clearly, over the last 5 months, this has been paramount to our team's success. So I was born, just a little bit about me, I was born and raised in Philadelphia, and I currently reside in Malvern, Pennsylvania with my wife and 3 children. One of those children might walk in the room any minute here asking for some lunch. We've had that happen in calls. In fact, as Jim said, most of the Girard team is currently working remote. About 35% of our team is splitting days in the office. We are trying to remain safe, and we've been very successful working remotely, so we're continuing to do that as the pandemic plays out. I am really excited about bringing my 25 years of experience to lead this team of great people, and certainly have gotten to see their great work over the last handful of months as we've managed through what has been a difficult time for all of us. And I'd like to really reinforce the message today that every one of our team, whether they're in client service, trust administration, or the wealth advisor that you may interface with, wakes up every day putting your goals first. And as long as I'm president and have breath in my lungs, that is going to continue to be the culture at Girard. That is what we'll hire to, grow to, and build to. One of the things I wanted to talk today about is the foundation of our business. There's 3 items I really want to identify and talk to you all about so that you get to know us a little bit better. And also, being the new guy, being the new president, give you an understand for what our mission and vision is as we move into the future. And a lot of this is being built upon or carrying forward what's been done so far. The first thing I'd like to talk about is our culture. And there's, as I mentioned, there's 3 things: culture, efficiency, and risk management. Culture is really the defining characteristic of any service organization. And at Girard, we truly have a client-centric culture. Our team is passionate about getting to know you. They're honest, sincere, smart, and truly put your interests first. And I really believe our most valuable resource, the foundation of our business, is our people. And having the right people in place directly relates to your client experience. We like to talk about, we don't want anybody with big egos or just interested in building their own career. We want team players who are interested in helping our clients. And if we do that, good things will happen, and we will continue to build off of that and hire to that. As president, my job is to nourish our culture. And for me, that means promoting personal growth, openness, integrity, and teamwork among our team. And we need to have a little bit of fun, too. That's something we're missing right now by mainly working remotely. And as we grow, I do not want these ideals to change. Our team and our culture, simply put, is the most important thing that we can foster for you, our clients. We want this to be a great place to work. And we want to continue to invest in our team. We have education plans. We promote people to get licenses such as a CFP or CFA, and that will continue. So what I like to say is our greatest assets are not the dollars we manage. It's a team of professionals dedicated to creating value for you, our clients. Second pillar I'd like to talk about is efficiency, or running a really efficient business. Over the last 10 years, the pace of change in wealth management has been pretty significant. There's been a lot of technology developed. It's been quite extraordinary. And we don't see this pace slowing down anytime soon. In fact, technology and interconnectedness of systems has allowed us to streamline our business to deliver value for you. And some of these things you may have witnessed on the front end, but a lot of them happen in the back end. So, for example, Tim, who is our Chief Investment Officer, he and his team implemented a system called FactSet. And FactSet is a industry-leading research software that allows us to bring in a ton of information and data about mutual funds or ETFs or stocks and parse in good information that we want to evaluate a company on, but also parse out the information we don't feel is relevant. And this is allowing us to make decisions faster and smarter. So very, very good investment we've made over the years. And it's, of course, a web-based software, so we can use it anywhere. Many of you on this call may use Black Diamond Portal. And if you don't use the Black Diamond portal, you could go to our website, meetgerard.com, log in, or reach out to your team, and we can get you set up. But that's an industry-leading wealth management software that allows us to manage portfolios, but also give you a portal to see your account, perhaps a little bit different. Performance, you can store documents there, and a lot better than perhaps an accounting system or a front-end bank custodial system. In trust, we have a system called FiTech, which again is a leading edge system in the industry, which allows our trust department to do some of the same things that our wealth management group does. 2 years ago, we made an investment in a software called Salesforce. Many of you may be familiar with Salesforce. Salesforce is the leading client relationship management software. And this allows us to manage all of our client relationships, put notes in the system of any conversation, task, of any request that you may put in. Again, this is a web-based system, which the time we put in helped us because we have people in a lot of different offices, but working remotely, the system has been a lifesaver. So at Girard, we're committed to efficiency. We're going to continue to invest in technology. We're going to continue to invest in platforms that make our business run better, but most importantly, with the focus to you, our client, that we want to make sure we're putting the resources in place that better serve you and give you a better client experience. But I can promise you this, as the world changes and as financial services innovates, we still believe in the value of human connection. So as much of all this technology is wonderful, it's still that voice on the other end of the phone or that meeting that we eventually hopefully can have, our connection to you, our client, that's most important. We want to know you. We want to make sure we're there for you. And the technology is just a tool to facilitate, to help us with that person-to-person approach. The last item I want to talk about is risk management or managing risk. And this may be quizzical to some of you as to why isn't it a pillar, but hopefully you'll agree that it's as important after I make a few comments on it. The first thing is, in wealth management, we are in a highly regulated business. We have multiple regulators that we answer to, both with our bank trust, our pension business, and our private client business. And we want to make sure that we're following all the rules that the regulators lay out. And these rules are ever changing, and it's a dynamic situation on an ongoing basis. But compliance and risk management is critically important, in particular that we're following along with what the regulators ask us to do, and we will continue to do that. The other risk that we've identified, or risk that we have to make sure we manage, is technology and cybersecurity, even physical security. Is your data secure? Are we managing all our vendors, or all the vendors we work with have good standards and security? And I can tell you, with the help of our parent company, Univest, this is a very important area that we spend a lot of time and resources. Another important part of risk management is really related to you. It's our ability to manage risk for our clients. Balancing your risk and reward is really important. Understanding where you want to go, what is your attitude towards risk, and making sure we're crafting investment solutions that fit the goals that you want to achieve. So, with all of these investments, from people to technology, it's truly for you the benefit of our clients. The future is bright at Girard. Our capabilities go beyond managing investments. We have estate planning, trust services, retirement plan services, financial planning. And with the luxury of being owned by Univest Financial, which is a 144-year-old institution, we also have the full complement of banking services. So as your needs change, as your life changes, as we go through your holistic financial plan, whether it's an asset-based loan, a mortgage refinancing, insurance needs, we're here for you. We want to partner with you to help you across the full spectrum of wealth services. And what we like to say at Girard is we're large enough to support you through the complex financial needs you may have in the future, but we're also small enough to truly care. So I really appreciate everybody taking a few minutes to spend with me today, and I certainly believe Tim and Jim are going to give you some really good information here about the first half and the second half of the year. But if there's anything we can do or I can do for you in the future, please reach out to your team or myself. There's a lot of resources on our website, meetgirard.com. We've invested a lot in communications, blogs, client education. Please use that as a resource. It's there for you whenever you want. And I believe this call, if you have to jump off early for whatever reason, will be recorded and posted there as well. It's our pleasure to serve you. And with that, I put it back over to you, Jim, and thank you.
Thank you, Dave. I appreciate it. And before we get started on the formal presentation regarding the markets and such, a little housekeeping item that we're required to put up, and that is some disclosures that you will see on the screen regarding forward-looking statements. As always, we would love to know exactly what's going to happen tomorrow, every day in the future and beyond, but that's not the real world, so we have these disclosures. And there's also some information on there about how we reference Girard, which is part of the Univest Financial Corporation as a whole. So we'll let that sit on the screen there for a moment. And then I'm just going to go ahead and talk about what is the first topic of the day, and that is a recap of what I'm calling the rocket ride that was the market's second quarter. It's hard to imagine this year started off so strange, but we just finished the second quarter. Here we are in the third quarter. The second quarter, as it turned out, was this rocket ride up. In fact, it may be a move that goes down in history as once-in-a-lifetime event. Certainly it was historic by any measure, and I know Tim has some data to talk about that. And then we're also going to talk about the first 6 months as a whole. It's really a stretch of time that at first seemed like it was the end of the world when we had February and March take place. But then, as so often as the market does, there's twists and turns and things that really surprised everybody involved and presented us with several surprising factors along the way. And at the end of the second quarter, it seemed like the world was, at least from the market's perspective, sort of back in its right place. So, Tim, let's go ahead and jump right into it and level set where we have been and where we are now.
All right. Perfect. Thanks, Jim. Thanks, Dave. And thanks for everyone for taking the time to join us today. Hope everyone's staying safe and sane, and really welcome to my home office. So we're really a stark difference, as you mentioned, from where the capital markets and the world was when we joined you last, which I had to look up was March 24th, one day after the market's bottom, and the Federal Reserve took the historic action it did to really combat this biological crisis from being the economic crisis, as we talked about quite a bit during our last conversation. But I want to quickly share with you some data that I had pulled just to give some perspective on the COVID-19 crisis that came from Johns Hopkins, a bit of a then versus now before we get into the markets and the economy. And just 3 months ago, COVID-19 cases in the United States had topped 68,000 on the day that we had gotten together. And unfortunately, that day also marked the event where we saw 1,000 deaths here in the United States. Up until that point, we had actually only seen 467,000 tests completed here in the U.S. In accumulation over the course of the year, with 77,000 tests alone that day, which was up from 15,000 tests a week prior. And just to give you some perspective on where we're at now from a testing and case perspective, we reached 3.8 million cases on Monday or Sunday of this week. We're unfortunately over now 140,000 deaths. And on Monday alone, we actually tested 769,000 people. So comparing that to the 467 in total, when we got together with you last on March 24th, with cumulative tests here in the United States breaking 46 million this week. So a lot of progress on the testing front, a lot of progress in combating the COVID-19 crisis front, and a lot of progress in combating what was a horrible first quarter of this year. Really a historic second quarter with the S&P 500 rising 20%. The NASDAQ actually hit an all-time high on June 23rd, being up almost 31% for the quarter. And small cap Russell 2000 index had risen 25%. So a historic one for the equity markets. In fact, it was the 99th percentile return, meaning that in 100 quarters, all 99 others had underperformed this one, which was interesting because we saw another 99th percentile in the first quarter, with that being the worst in market history. So a lot of volatility, and we certainly appreciate your trust and patience as we navigate through these challenging times. As to be expected, bonds trailed all equity markets for the quarter. Long-dated treasuries returned a little bit more than 0.1%, while U.S. corporates did better, with the Barclays Aggregate Bond Index returning about 3% in the last 3 months. The 10-year U.S. Treasury actually only moved 4 basis points. That's 0.04%. the least in any quarter, despite the scorching move that we saw in risk assets. And maybe my most memorable statistic, we got a lot of client phone calls about this, oil gained 91.75% over the course of the second quarter, yet a gain of 92% in oil futures after they turned negative for the first time in history at the end of the first quarter. Just if you're wondering why that's a possibility, it's the cost of storage that gets baked into the price. So last but not least, the dollar weakened about 2% in the last 3 months. It has continued to weaken after the second quarter concluded, which will be an interesting trend to follow in coming quarters, especially for international stocks.
Tim, I think it's interesting with the oil markets because these numbers where oil, technically went below zero and then these, a 91% gain, it's funny because if something is priced at 2 and it goes to 3, that's a 50% gain. And then, of course, there's percentages and then there's real dollars. And so when we look at these numbers, it really is fascinating what you said. First quarter historic down, second quarter historic up. And I love the fact that you take things very evenly and impartially without being pejorative one way or another. It's great or it's bad. It just is what it is. So, the data is very, very helpful, and that's, I think, what helps us manage the assets is when we look at things just as they are without baking in the emotions of it. And really, this snapback in financial markets, literally, this is whiplash. Way down the first quarter, rocket right up the second quarter. And frankly, it's led to some confusion, really, given that the economic numbers themselves are so awful. The initial lockdown, subsequent social distancing measures to combat the virus, and all the angst that goes with that, and the likely effect that we've seen, technically speaking, the worst recession, or if you want to say mini depression, since the 1930s. So what are we seeing from the economy right now?
Yeah, so to your point, it's been sort of hard to fathom some of the economic data in juxtaposition with how the markets perform. We've seen some really unbelievable numbers, coming from the economy that are really eye-popping and unfortunate, obviously. The weekly jobless claims report that came out the day that we had come to you last on March 24th was an outrageously unlikely event from a statistical perspective. 30 sigma or standard deviation event is basically a similar probability of winning the lottery 22 times in a row, as regrettably 3 million Americans filed for unemployment insurance that week. As you can see on the chart, that massive spike. And we could go all the way back to the early 1900s to show you that, and there's nothing that even comes close to the amount of Americans who filed for unemployment insurance that week. At the peak, 40 million Americans were out of work due to the government-mandated economic shutdown, leading to an unemployment rate that we haven't seen since the 1930s, and has continued to really improve, getting closer and closer to that 10% number after getting much higher than that over the course of the last several months. But as far as the economy in the United States as a whole, we're expecting it to contract about 40% in the second quarter after it fell about 5% in the first quarter. Like you mentioned, it will be the deepest recession since the Great Depression. Actually, it will be the deepest recession that we'll likely ever see, hopefully in our lifetimes. But it will also be the shortest recession, as we have seen the partial relaxation of the social distancing behavior, causing a sharp bounce in the positive direction to economic activity. And, I think, the estimates and range of outcomes is narrowing slightly, but, it continues to be something that we're still, getting our arms around every single week as we look at some of the high frequency data from, hotel bookings, the restaurant volume, how, the shipping ports are continuing to get back up online. Not just here in the United States, but around the globe. And as a result of this improving data, we expect to see gross domestic product, the goods and services we produce as a country, surge in the third quarter to the tune of about 15 to 20% annualized year over year. Again, with manufacturing, construction, auto and home sales moving back more closely to normal levels. But things will probably start to level off a little bit in the fourth quarter. Ultimately, the vaccine is really what's going to be able to deliver us sort of that normal environment moving forward. And coming off the difficult year that we had this year, where we expect GDP to perhaps decline somewhere in the 6 to 7% range, we expect GDP to grow somewhere in that 6 to 7% range in 2021. And a lot of that's been priced into the market. So again, just a couple quick data points that have been on the positive side of things. Non-farm payrolls in June hit 4.8 million. It was a 7.5 million increase in the last 2 months, reversing about a third of the 22 million jobs that we lost in April and in March. And then the ISM New Orders Index hit 56.4 versus 27.1 in April. That was a June number, the 56.4, which was the second largest 2-month change going back to 1948, which again measures demand in manufacturing. So, again, a lot of positive numbers coming off a very low base. Looking at TSA bookings, literally down 99% year over year, and now being down somewhere in that 50 to 60% range is a massive move, to the upside. But we still have a ways to go. And again, without a vaccine, that's the only thing I can, from a healthcare perspective, I believe that will allow us to have the resumption of normal, and could lead to some volatility in the financial and capital markets, perhaps in the latter part of the year, if it gets delayed a bit.
Yeah, and I think you're right. The scenario is, it's easy to come off the low, but then to get back to that very, very high point, that takes a little bit more work. But nonetheless, the numbers are positive, and that's the key thing. So as we're watching the economic implications of the COVID-19 induced recession, boy, I think what a phrase that is, COVID-19 induced recession. That goes down in history as a phrase. But as we watch this unfold, what are the driving factors pushing this market up right now? I mean, this rally has been amazing. What is it that's driving this?
Yeah, so I think it's a two-part answer, a two-part equation to why the markets have responded. Before I get to that, the market's priced in a lot of bad news very quickly. In fact, it was the most quickly from the market peak in February to the market low on March 23rd. We've never seen a decline in the markets, in the stock market that is, so fast and so significant. And really, the day before we had gotten together last, the Federal Reserve came forward, Congress came forward really to the rescue with accommodative monetary policy and other stimulus measures to basically get the economy back on its feet. And so, really the first part of the equation is that every bull market has begun with the Fed cutting rates. Usually recessions are induced not by a global pandemic, but the Fed raising rates too quickly. Now that they've cut, this one's no different. The bull market has begun with the Federal Reserve responding in a very accommodative way after the collapse of the economic activity basically happened overnight, and then overwhelmingly, seeing a collapse in risk assets respond accordingly. All in all, the economy has been flooded with stimulus. Over $2.4 trillion in stimulus has been put into the system to counteract the measures to slow the virus, which is the equivalent of about 12% of U.S. GDP. And as many of our clients have noted and asked, and something we may want to discuss in a bit more detail as we get a little bit closer to being out of this whole mess, it's going to come at a high fiscal price. Debt to GDP ratios should reach a record high by the end of next year, and this will be likely even higher than where they were at after World War II. With the stimulus, though, like it was in the global financial crisis, we viewed it as absolutely necessary. It restored liquidity, it restored confidence in the markets. Again, after we haven't seen this deal of stress since the global financial crisis. And to their credit, the Fed acted much more quickly than it did back during the global financial crisis in 2007 through 2009, seeing how broken the economy was from shutting down overnight, and then really bringing that relief to the markets very quickly. Congress responded strongly as well, and many have anticipated before Congress goes away in August for, I'm sure, their much-needed vacation, another $1.5 trillion package that we'll likely see to continue to support the economy and the American consumer to get through these challenging times. The second part of the equation, as far as why the market has responded significantly, is that there really isn't any other alternative to risk assets with interest rates at zero again, with no end in sight. And you might hear the phrase in the media, TINA, there is no alternative, and it's referencing the demand for risk assets compared to, for example, low-yielding treasuries. And in fact, the new projections released after the June 10th FOMC or Federal Open Market Committee meeting, all 17 participants said they expect to hold rates at zero until next year, and 15 of them had projected rates will stay there through 2022. So fortunately, as Jay Powell, Fed Chair Jerome Powell had quipped, we're not thinking about raising interest rates. We're not even thinking about raising rates. So thank you, Jay. It's been, obviously supportive of the capital markets and risk assets abroad. So for investors looking to find income and returns over the rate of inflation, they've piled in the stocks, they've piled in the corporate bonds, they've piled into a lot of risk assets, just like they did after the global financial crisis. And in other words, there is no alternative, therefore finding, I think, good reason that these asset classes will remain relatively resilient in the midst of this recession that we're going through.
Yeah, and it is fascinating. There are some parallels to 2007 through 2009, and there's some differences. But the fact of the matter is the tools are what they are. When interest rates come down, people look at other assets, so it makes sense. Shifting gears a bit with this economic disruption and subsequent change of routine, I know my change of routine for 3 months, it was kind of fun working from home for about 7.5 minutes, and then I thought, boy, how can I get back in there? But nonetheless, some people like to work from home, some people don't. The key thing, though, is it was a change, and all of us have been exposed to these new technologies, or at least increased integration of new ways. I know that I've worked from home many times for slices of time, but I haven't worked from home for weeks at a time. So these integration in new ways, whether it's home delivery of groceries, to virtual interactions with family and work colleagues. I think of how many people, had springtime holidays or summer holidays via Zoom or WebEx like we're doing today. This world has literally seen a decade's worth of growth and change in a span of a couple of months. I think on our banking side of Univest and Girard, how so many clients that were kind of resistant to do online banking, and they drove up, the doors were closed, they saw the line through the drive-through as 75 cars long, and they said, I guess I have to do online banking. So, change is good, it's just uncomfortable. So what are some of the key growth areas, though, that this disruption, these themes of disruption could be permanent here? What are some of these themes that you see?
Yeah, I think the first one you had mentioned, absolutely is one that I hope is here to stay, maybe in a different form than we're experiencing right now, and has many investment opportunities and consequences is remote work. The share of remote workers, those who are fortunate like ourselves who are able to work from home during this time, has quadrupled to 50% of the nation's workforce, according to a survey of 1,500 hiring managers by Upwork. So as you mentioned, many of us are now living at work instead of working at home, though. And I look forward to getting back to the office at least a little bit. So I'm not just, here all the time and see my colleagues and team. But as I mentioned here at Girard, and as Dave had gotten into, we've been largely working from home with the majority of our office home since March 13th. And given the recent guidance from Pennsylvania, where most of our offices are located, we expect to be here for the large part through the rest of the summer. So thankfully, as Dave mentioned, years worth of substantial investments in enterprise cloud technology have enabled us to have a seamless transition to our homes from our offices, and really forcing, I think, a lot of businesses like ourselves asking the question, do I really need all this office space? I think the question that my wife and I have is, do we need more office space at home if this is going to persist? Because as you probably can see in my background, that not only is it our home office, but it's also our workout room. We've got the Peloton back here. But, in another survey, a software company called Buffer actually asked 2,500 remote workers about their experience working from home. 99% of them said that they like to work remotely for at least some of the time for the rest of their careers. So it's definitely a trend that's here to stay, and I think as a result is going to create a lot of opportunities in various sectors, many of which that I think a lot of investors maybe haven't even thought of. And in the last quarter, a lot of companies in a variety of industries, ours included, have noted this surprisingly smooth transition, working remotely, and large, diverse companies have envisioned needing less office space than they did once before. CEO of Facebook, Mark Zuckerberg, recently said that the company plans to aggressively open up remote hiring. And then on the other hand, Microsoft's Satya Nadella, CEO, recently shared that maybe we're burning some of our social capital that we've built up in this phase while we are all working remote. And what's the measure for that? So, again, I feel strongly that our culture, like Dave had discussed, is not what it is today if we're all at home. It's a team of 75 that have been relatively together for a long period of time. But what happens when we start, integrating new employees and growing our workforce? How do we get to know one another in this format? So I think the biggest industry, and we recently wrote a post about this, it was emailed to you about a couple of weeks ago, and it's also on our blog, really talking about the consequences for commercial and residential real estate, and meaningful opportunities in technology infrastructure will be there, and I think we'll be writing about those, especially on the cybersecurity side of things, in the weeks to come. So all these things, the support work from remote, cloud-based communication software, enhancing cybersecurity, and even something as simple as trying to separate work and play, by maybe upgrading your house into something that's a bit larger if you're going to be permanently working from home, and like Dave said, not having your kids knock down your door. So, like you said, there's a lot of change happening in a short period of time that, we need to keep a close attention to.
Change, that's a key word, and it's ongoing. We always hear that, but wow, it was like a tidal wave this first and second quarter.
Yeah.
So I know one of the secular growth trends too, and it's been with us for a while now, but it really got accelerated recently, is just e-commerce. So Amazon, I just saw, celebrated their 25th anniversary last week, and I think, wow, 25 years, that seems like a long time, but relative to a lot of things, it's a short time. And what a company that started off as an online bookseller has obviously morphed into something quite a bit more prevalent and far-reaching. And so now with the economy opening back up, some people think, oh, I'll just go back to the store. And I know some of the retailers had great sales for the first couple months of the reopening, and that's good to see. But the reality is that e-commerce is also growing. So I know the analytics from high-frequency data has shown that e-commerce volumes have continued to grow, especially the first 6 months of this year. And digital payments, that's another one. They're continuing to supplant old-fashioned cash. So tell us a little bit more about what's happening there.
Yeah, it's a great point, Jim. When you look at e-commerce sales, one of the things I was expecting to trail off a little bit was e-commerce sales when the economy started opening back up. I would have assumed that consumers would have started to go to brick and mortar stores a lot more, and similarly, probably not as much as they had before, but at least e-commerce sales would have trailed off a little bit. But we really haven't seen that in the data, which makes me think that e-commerce is here to, obviously here to stay, but a lot of the consumers who may have used a brick and mortar store to access some of these goods and services are now opting more permanently for online. So like you said, e-commerce has played a key role in keeping consumers and helping businesses in unconventional ways during the COVID-19 crisis. And I still marvel at how many transactions are done pre-COVID-19. And the World Bank recently had a survey out that found that 31% of adults worldwide still do not have access to a financial account, and e-commerce is only 11.8% of all retail sales here in the United States, according to the U.S. Census Bureau. So some pretty interesting numbers, and goes to show how much these businesses that are really transitioning from brick and mortar to online sales really have to go as far as growth is concerned. But as you mentioned, full contactless payment can continue to grow as global consumers move from cash, and also as other consumers feel more comfortable shopping online, whether it be for a cheeseburger delivered from their favorite restaurant or the weekly groceries. And according to Google search data, food delivery services searches had grown 300% globally year over year. Searches for online pharmacy had jumped 100%. And going back to what we discussed before, searches for telecommuting had reached an all-time high in the United States for Google and YouTube. So obviously consumers are thinking about these things, but it's not just the consumers, it's also companies at the enterprise level. We've seen an acceleration of innovation over the course of the crisis. Companies have been rolling out curbside pickup programs, contactless checkout. Retailers and marketplaces have been adapting to reflect the shifting needs of consumers, trying to focus on what are considered probably new essentials for many of us. So we've seen online and offline partnerships forming to expand customer reach, broaden their selection, and then the enablement of fulfillment of last mile delivery networks has been stretched beyond their limits, and a lot of investment needs to be had in these areas. So, like you said, COVID is driving technology adoption beyond software as warehouse automation, through robotics, pushing the need for workers to socially distance on warehouse floors, and also the efficiency of, what is now a 24-hour work cycle for a lot of these warehouse fulfillment centers. So all this is going to lead to opportunities in sectors across the board: financials, industrials, technology. Businesses need to invest in efficient mobile applications and data security. And I think even some of those old boring credit card stocks, still have a lot of ways to go and growing, especially in some of the developing emerging countries that are out there. And not to mention that I think we're going to have chips and sensors in pretty much everything these days, and there's a lot of exciting opportunities as a result of that.
Yeah, there's definitely some lasting opportunities and changes that come from all this. I think of the agrarian economy, and that was replaced by the industrial economy, and then that's replaced by the service economy. And who knows, maybe 30, 40, 50 years from now, we'll talk about the pandemic resilient economy as a result of all this. So, these events are rare, fortunately, because they're a little rough to go through, but they do create a wave of innovation, and not to get any kind of political thing, but when I think of America, how we are able to lead this innovation, I think that's one of the great strengths is, we take a step back, we figure out a new way to do things, and we move forward. And the great economist Joseph Schumpeter, he used the phrase creative destruction, and I love that phrase. I think that says it all in two words. Something creative comes by, it kind of blows out an old way of doing things, and then there's this initial shock and fear, but then people realize, hey, it's a better way, and we move forward. So I can't think of a better phrase to describe our current times, creative destruction. So moving forward now, we'd like to address some questions that were submitted in advance, and many of them were similar in nature. We had a lot of questions come in that were directionally similar, so what we did, rather than take an extra 10 hours to try to answer all of them, we kind of meshed them together into a common theme. And the first one, this is a big one, and here is the crux of the biscuit, as the famous singer used to say, and here's the question. I have concerns about the election, and I'm tempted to pull out of stocks entirely until after November 3rd. Should I sacrifice potential gains in favor of protecting my assets now? Tim, take that one and be delicate with the politics.
You got it. Yeah, and thanks for your question. We've got a lot like this, especially within the last couple of weeks as the polls have changed. But I think there's really two things worth addressing in this question. First is the election. The second is market timing. Our plan is to continue communicating with you, our clients, on a regular basis about our thoughts on the election, potential implications. We have plans to have this, conversation again sometime in early October, as we're getting even closer to a month away from the election, to give you some of our perspective. So it will certainly become something a bit of a theme, obviously, being an election year. But as far as regards to the election, prediction markets right now are suggesting that the Democrats will control and sweep the White House, the Senate, and the House. Of course, the markets are forward-looking, and I really believe that investors are generally aware of how Democrats are performing in the polls recently. Therefore, it may not come as much of a surprise to investors as maybe some of our clients have suggested. Maybe the markets will sort of panic. I think this information is well known and distributed, and I think the markets have been doing a pretty good job digesting it, and perhaps will not cause as much volatility as maybe some have suggested. The big race to watch is really the Senate, and it's very much up for grabs. Republicans currently have control of it, and if they continue to maintain their Senate control with Democrats having the House, it could really create a situation of status quo and really nothing getting done, which provides a lot of certainty for the markets who love to have that certainty. The Republicans have a 53 to 47 Senate majority. They have 23 seats up for election in November. Democrats have just 12 seats up for election. And according to latest polls and prediction markets, Democrats are likely to capture 6 seats and lose 1 for a net of 5, enough to gain majorities for the first time since 2014. But however, as it's the case in presidential election, the winner of the Senate races may not be known until well after Election Day. Due to COVID-19, a unique characteristic that we'll be experiencing this year, I think, is a lot of mail-in votes, which are going to take some time to count. And as a result, if you are trying to get out of the market and do some timing, which we won't suggest and I'll get to in a second, you could be sitting on your hands for a while. It could be a couple of weeks before we really find out how the Senate will likely go, which again is in my opinion, the most important. So, right now, as far as the stock market's concerned, I think really the market's more concerned about the COVID-19 crisis and the economic data and the recession, as they are much more so than they are with the election. I think they're more going to be very interested to see, how President Trump and Vice President Biden, if they, either were to be elected, come November, how they're going to handle the COVID-19 crisis, how they're going to get out of the election. and call me the optimist, I think the major consequence of a Democratic sweep is this proposed tax policy, which would reverse a lot of the Tax Cuts and Jobs Act regulations and rules related to corporate earnings, which has really been the focus of our team thus far. Higher corporate taxes will reduce corporate earnings, and obviously that has an implication on the valuation of the stock market. But there could also be some other policy measures that offset some of these losses and earnings, such as a softer stance on trade, greater government spending, and other policy measures. So with the economy right now on some shaky footing, it may be something that if the Democrats were to sweep, wait a few years before attempting to push through and hurt companies even more. And again, maybe that's my optimistic view on things. I just don't think that they're necessarily going to attack companies who are just getting back on their feet with higher taxes right off the bat. So again, although presidents can implement executive orders, legislation requires congressional approval, hence the importance I'm placing on the Senate as far as the legislative branches of the government. So again, we'll write more on this and update you further on our next conference call. But as it relates to market timing, our mantra has always been stay invested, stay disciplined, and take advantage of market volatility. Market timing, while tempting, involves getting nearly two impossible decisions right: when to sell and when to get back in. We are long-term investors here at Girard, and trying to time the market, tops and bottoms, can be a fool's errand. And the evidence is overwhelming that most investors diminish their long-term returns in trying to do so. Investors get more likely to chase the market up and down, getting whipsawed, buying high and selling low, ultimately deteriorating their return. And if you were to look back through the end of last year and had invested $100,000 on December 31st, 2004, and looked and see how that in the S&P 500, and seen how that has grown through the end of last year on December 31st, 2019, it's led to 9% per year in performance, growing at $100,000 sum to a little bit more than $364,000. And if an investor who also invests on the same day but missed the best 10 days in the market, of which we've had some that have become the best 10 days within the last couple of months here. With all the volatility that we have, they most regularly come after some of the worst days. That investor's return was a little over 4%, meaning that 100,000 is only 183,850 at that time last year. So, it's a significant consequence from a financial planning perspective. The next 50% move higher in the S&P 500 would lengthen that gap between those two investors, one that just stayed the course and the other that missed it on those 10 days. To the tune of $271,000, which for a lot of our clients is a large sum for a financial planning perspective, and continues to grow and get worse, as time goes on and depending upon your horizon. So we rebalance into weakness. We want to take advantage of volatile market environments and hopefully get some of the best prices within the market cycle when we're doing that. So I think the bottom line, take a step back, and Warren Buffett has plenty of quotes about this. The U.S. stock market has been resilient through history. Stocks routinely recover through short-term crises, just like they have from the March lows. And trying to predict the best time to buy and sell, you may miss out on the best market gains, and they can be more costly than just trying to avoid that speed bump in the first place. So on November 4th, we'll all wake up. Trends like consumers buying more groceries online, companies spending on cloud infrastructure, me needing to go to Home Depot on Saturday to do some touch-up with paint. All those things will still be here, making for an exciting time to be an investor in our country.
Yeah, Tim, I think that's great perspective. And I know from a time standpoint, we're a little bit limited, but I personally would love to go on and on about this. I'm just going to throw one quick thing at the risk of sounding like a sales pitch, and that is this. If there's anything that clients hire us for, it's to help pull emotions out. I mean, there's a million reasons to hire us: financial planning, investment planning, estate planning, et cetera. But if we can help clients pull that emotion out so that they don't simply make a bad mistake, that is so much of success right there. And we don't know for sure, but we never know for sure. The fact of the matter is 2016 was uncertain, 2012 was uncertain. I think back to 2000 with Bush and Gore, that we didn't know because of Florida and all this weird stuff with that, and it took about 6 weeks to figure that one out. But in the meantime, Apple was making, well, I guess in 2000, they weren't making iPhones, they were making iPods, and Clorox was making bleach, and General Mills is making Cheerios. So the fact is, These companies are resilient, they adapt, they move forward, and our job is to help people build that portfolio and stick with it. So enough of that. One last question then, Tim, in the interest of time here, and this is a little bit addressed earlier in our presentation, but this really hits it a little bit more accurately. Rem acu tedigisti, as they say in Latin. There you go. There's your Latin phrase for the day, folks. The question is this: market valuations, in particular related to information technology. That's the area, part of the NASDAQ, that has led so much and has not only fully recovered, but has gone to new all-time highs. What's your sense of valuations there, Tim, in the information technology? Are they overvalued, or are we fair? Where are we at?
Yeah, great question. One that we're thinking a lot about. Our chief equity strategist, Bruce Freeston, runs our equity research team. It's been something that we've been discussing at length. Actually, they had just gotten together this morning to go through one of our strategies. And of course, the always discussion is, technology and how it's become such a large part of the S&P 500 and performed so well this year. So I think there's really two parts, to the answer. One is, in a growth-starved world where interest rates and yields are very low, investors are going to feel more comfortable paying for a company achieving higher rates of growth than their peers from a valuation perspective. And have to remember, with investing, everything is relative to one another. Bonds to stocks, stocks to bonds, price to earnings, price to sales. These are relationships that are very important for you to understand as an investor. And very simply, while the long-term S&P 500 PE multiple on a forward basis is around 16.5 times in the last 25 years, meaning investors are comfortable paying $16.50 for a dollar of earnings in the S&P 500, investors will be more comfortable paying a bit more for that dollar in earnings when the alternative, or bonds, are yielding very little and inflation is not really a threat. So right now, to really the point of your question, valuations for the S&P 500 are 1.5 standard deviations from the mean, or quite a bit away from the average of 16.5 for next year's earnings, maybe suggesting that we've gone a little too far, too fast for the S&P 500, but also for technology stocks. But these are estimates based upon expected earnings. And then, like we had said earlier, there's a wide range of economic outcomes, uncertainty surrounding the economic recovery. A vaccine could come through more quickly. The strong rebounding economic data could continue at the rate that it has. The labor market could continue to rebound in a way that the market's not fully appreciating. And if this were to unfold, there's going to be a lot of companies and sectors that are actually undervalued right now, as opposed to being undervalued. On the other hand, second wave, delayed vaccine, labor market that gets stuck in the mud, that would suggest to the market and that investors, maybe are paying a little bit too much for that dollar in earnings next year, and that maybe we're a bit overvalued. So the bottom line, we're in a tough spot, lots of potential outcomes, broadly speaking. Usually when we're talking about earnings growth over a year, the market's sort of hemming and hawing about a range of 6 to 10% or something along those lines, and not nearly the wild range of outcomes that we're currently experiencing. So, it's obviously something we're watching very closely. As far as the technology sector itself, investors have found comfort investing in this sector because it's really at the forefront of the transformation that we began discussing earlier. And software companies in particular have seen little change in demand. In fact, demand might even be accelerating for their services during this time. And therefore, earnings and revenues haven't deteriorated or evaporated like they had been destroyed in areas or industries like casinos, hotels, and airlines. Many of these companies have long-term contracts with a reoccurring revenue. Dave mentioned FactSet earlier. They're a publicly traded company. Our contract's 2 years, and as our team has grown, we continue to add more licenses. The conference software that we're utilizing today, our client portal, the mobile app through Black Diamond, again, all these companies are publicly traded, where businesses like ours are still paying their bills and even expanding our contracts due to our needs for working from home. So in many ways, the technology sector has become sort of like a consumer staples, whereas the American consumer cannot live without staples like cereal or toilet paper. Businesses can't live without enterprise cloud conferencing solutions, for example, and as a result, their valuations have gotten plumped up. With all that said, there has been a lot of speculation. The rise of the day trader is here again, leading to a lot of companies that simply look very, very overvalued. So while I'm not extremely concerned about the entire sector, as you sort of look under the hood, there are a lot of businesses that I have deep concerns about. So I don't necessarily think the overvaluation is true for some of the mega cap technology companies, but more so for some of the cult-like stocks, one of which has a brilliant CEO, a little controversial. They report earnings today, and I'll just leave it at that. But there definitely are some really overvalued names in the sector. The sector is trading at valuation levels that we haven't seen for a while. But no, I don't think this is another tech bubble at this point, and I wouldn't think that were the case until we move probably another 50 to 100% higher.
Excellent information. Just a side note here, we've had several people type in questions through the WebEx portal that we have here. So we are going to address those questions later. We just, in the interest of time, we're not going to be able to get them in today. But thank you for those questions, and we will answer those questions. So, Tim, thank you for your time today and insight. It's very helpful recapping the events in the front half of 2020, as well as taking a look at what the future may hold in the back half of 2020 and, frankly, and beyond. And many thanks to all of you that have dialed in and joined in via the computer today. We appreciate your time. I think it went great. Hopefully my technology worked. I think it did. I know when we did this in March, we were sort of a little uncertain with all this, but as Tim has alluded to, and I think as we've all seen in the last 4 months, technology is getting better. We're getting very comfortable with this, and we plan to do this again in October. So please do join us, especially if you have concerns on the political side, because we're going to take a much deeper dive into that in the October presentation. So if you are a current client of Girard and need additional guidance, please contact your respective investment advisor. Reach out to him or her. And if you're not currently a client, you are absolutely welcome to visit our website, which is meetgirard.com. So that's meetgirard.com, meetgirard.com. You can find contact information and telephone number to your local office. And as you grow, we grow, and it's our privilege to serve your financial needs wherever this journey takes you. So thank you again for joining, everyone, and we look forward to speaking with you again in the next 3 months.